If you've ever looked into your non-registered investment account and realized, hey, this stock is deep in the red, and how could I use this particular stock? You might be surprised to find out that these losses may actually help you save taxes. This strategy has a name. It's called tax loss harvesting. And no, it's not shady. It's something that's legitimate and that everyday Canadians are using this strategy to lower their tax liability. Hi everyone, welcome to my Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And today's topic is the deep dive into tax loss harvesting. But before I get started, make sure you give us a thumbs up and hit the subscribe button below so that you can stay on top of the latest tax tips. Now with that, let's get started. What tax loss harvesting actually is. Tax loss harvesting simply means you intentionally sell an investment that's in a loss position. So then you would be able to realize a capital loss on the sale of the investment. And you would then turn around and use that loss to offset against the capital gain that you realize on the sale of a different property or different instrument. Now let's go through an example to explain. Let's say you sold a rental property and you made $100,000. And you look into your non-registered account investment portfolio and you notice the stock that you've invested in is having this loss of about $20,000. Now it's year-end time, almost at the end of the year. You have a choice. You already realized $100,000 capital gain on the sale of the rental property. And now you look at the stock that's giving you a $20,000 loss. You have a choice to decide whether you want to realize the loss or not. If you do choose to realize the loss on the sale of this stock, which is $20,000. Now, having a $100,000 capital gain realized earlier on the sale of the property, realizing the capital loss on the sale of the stock of $20,000, the net amount of the two is $80,000. And now, what it means is that by harvesting the loss on the stock, you only need to pay tax on $80,000. But it's important to note that you don't actually get tax refund from realizing the loss. The loss can only be used to offset against the capital gain that you would otherwise need to pay tax on. Now let's look at where you would be able to use this strategy on. Well, it's important to note that this tax loss harvesting only works in non-registered accounts. This would include a cash or margin account, non-registered brokerage account, joint investment account, but it does not work in TFSA account, the registered retirement saving account, the RRIF RIF account. It also doesn't work in RDSP account, the registered disability tax saving account. It also doesn't work in the RESP account, also doesn't work in the FHSA account. If you sell the stock that's in the losing position in one of these accounts, you gain no tax benefit at all. You would not be able to use the losses that you realize within these registered accounts to offset against the capital gain at all. Now let's look at how capital losses actually work in Canada. In Canada, all capital gains and capital losses fall into the same bucket, no matter where they come from. What this means is that you can realize a capital gain from selling a property and a capital loss from selling a stock, and they can offset against each other, even though the type of investments, underlying type of investment are different. Here's a general rule though. 50% of your capital gain that you realize would become taxable on your tax return, and only 50% of the capital loss that you realize would be able to use to offset against the capital gain that you earned. So here's how the laws actually get applied. Firstly, when you realize a capital loss in the year, you would be able to use that loss to offset against the current year's capital gain. And if there is a net gain situation, you pay tax on the taxable portion of the net gain. On the other hand, if you have more capital loss than the capital gain, any residual loss can be used to 1. Carry back for 3 years into 3 prior years tax return to offset against any capital gain that you've realized in the 3 preceding years. First, you can carry back the net loss to offset against capital gain you realized in the 3 preceding years. And so what it means is that you can apply the losses retroactively, and you can fill out a form called T1A, T1 adjustments, and you would be able to carry back the losses to prior years. On the other side, if you did not have any capital gain realized in the 3 preceding taxation years, what you can do with any net loss that is unapplied is to carry forward indefinitely. You would be able to carry forward to apply the losses to offset against any future capital gain that you would realize. So it could be indefinite, and there is no limitation on the capital loss that you are allowed to carry forward. The only catch is that the capital loss would only be eligible to offset against the capital gain. Now here comes the big trap, the superficial loss rule. One of the biggest tax traps in tax loss harvesting is this rule called superficial losses. The rule doesn't just look at you, but it also looks past you and look at people that are around you, including the people that are affiliated with you. It also looks into your corporation in terms of what they own and how they invest within 30 days after you sell the underlying investment for a loss. If you, any of the affiliated person or entity, repurchase the same investment within 30 days after you sell it for a loss, the loss can be denied completely and deemed to be superficial loss. So in summary, the superficial loss would apply if both of these happens. You or your affiliated person or entity sell an investment at a loss. 2, you or an affiliated entity or person buys back the same investment within 30 days before or after the sale. And you or the affiliated person or entity still owned it 30 days after the repurchase. If those conditions are met, the losses are deemed to be superficial. And it means that if the losses are denied and the losses are added back to the adjusted cost base instead. This is why understanding what counts as an affiliated person or entity is important. It's also important to point out what identical investment means. So who counts as affiliated? The term affiliated has a special definition within the context of Income Tax Act. It practically includes everyone or everything that CRA considered to be you effectively. Here's the practical breakdown. Now, first, you as a taxpayer, this would include all the accounts. You sell the investment, let's say you sell the stock that's in a losing position and realize that $20,000 loss. And you turn around and purchase the same stock within your RSP account or your TFSA account or even the RESP account that you set up for your kid that you own. That would still be considered you or affiliated to you. Or you repurchase the same stock that you realize the loss on within your corporation that you own or you control. If any of these accounts, including your TFSA, RSP, the RESP, or even your corporation, repurchase the stock that you realize a loss on within 30 days, the losses are considered superficial loss and therefore the losses would be denied. Another example of affiliated person is your significant other, your spouse, or your common law partner. This is the one that most Canadians miss. Let's say you sell RBC shares for a loss and your spouse turn around and purchase the same RBC shares within 30 days after you realize the loss in their own account. CRA would consider the repurchase as an affiliated person repurchasing the same stock, and so the loss would be denied, even though you didn't technically do anything within your own account. Another example would be the corporations that you control. They're considered affiliated entity. So if you own those entities for more than 50%, directly or indirectly, the corporation is considered affiliated entity. And if the corporation repurchases stock that you just realized a loss on within 30 days, again, the loss that you realize would be considered superficial loss and it would then be denied by CRA. And the losses would be added to the cost of your adjusted cost base of the stock, and you would not be able to claim the loss to offset against the capital gain. So why does this matter to you and me? Well, because the rules applies to all affiliated persons and entities. So you need to monitor your own account, your RSP and TFSA account that you may or may not have control over, because sometimes we use a financial advisor to execute those trades for us and manage the account for us. Your spouse accounts and the investment accounts that your spouse investment advisors are controlling. The corporate accounts that you're controlling. Generally speaking, the superficial loss rule is way broader than what normal people expect. And it is the number one reason how tax loss harvesting fail. Now, the second requirement is that you cannot repurchase the same or identical investment. And so what counts as identical property within Canada, within the context of superficial loss? CRA actually has a very strict definition about identical property. So CRA look at two properties if they are same in all material aspects in the eyes of CRA. This means that there is no meaningful differences between the two. So one easy example is that you sell RBC shares, it's publicly traded, the same type of shares, and then you repurchase RBC shares. Those are identical shares. Another example, you sell Bitcoin and then you repurchase Bitcoin within 30 days after you realize the loss. That is also considered superficial loss. It's identical Bitcoin, repurchase Bitcoin, same instrument. There's no material difference between the two, same. So it could be considered identical property. Now let's look at some examples that are not identical. Now from a mutual fund perspective, this is perfect example. Let's say you sell your investment in Vanguard FTSE Canada All Cap Index ETF, and then you repurchase a similar fund, but it's from a different provider. iShares S&P TSX Cap Composite Index ETF. So two different kind of funds. Even though they are similar, but they are not materially the same, and therefore they're not considered identical. So if you realize the loss on one and you want to repurchase a different fund altogether, that would not be considered identical property. And so the losses would not be deemed to be superficial loss. Another easy one would be you sell Bitcoin at a loss and then you decide to buy Ether instead. So then it would not be the same stock, it's different. It would not be the same type of cryptocurrency, and therefore the losses would be allowed. Another good example is different classes of shares. If you sell RBC preferred shares A, but then you repurchase RBC preferred shares B because they have different attributes in their shares and they're not identical, and therefore the losses would not be deemed. So the transaction would therefore not be considered superficial loss because the assets would be different. Now, the easiest way to avoid superficial loss is for sure wait 31 days if you want to repurchase the same instruments, same investments, or alternatively, you're bullish and you think that there would be a lot of fluctuations in terms of pricing over the next 31 days, you can buy something similar but not identical. For example, you sold Bitcoin, you may want to buy a Bitcoin ETF, or you may want to buy long call options on Bitcoin, so then you can still mimic the same movement of the investment, but allowing you to realize the loss and take advantage of the loss position on the underlying investment. Now, another important aspect about tax loss harvesting is the settlement date. So in order to be counted toward the loss realized in 2025 as an example, you would need to make sure the settlement date happened within 2025. And it typically takes one business day for the Canadian security brokerage to clear the transactions and settle the transaction altogether. So what it really means for 2025 is that you have to make all your sale on December 30th because it takes one day for the brokerage to clear and settle everything. So by December 31st, which is the last day of the year, last business day of the year, you would have the whole stock transaction all settled. So then it allows you to count the loss within the same calendar year, within 2025. And that could be reported on your personal tax return to offset against the capital gain you realized earlier in the year. We've covered a lot about the ins and outs of tax loss harvesting. When would it make sense to apply that strategy to your life? Well, you have capital gain or you are expecting capital gain to be realized within the same taxation year. Number two, you want to clean up the investment that are in the loss position. You may also want to rebalance your portfolio and you want to pay less tax. who doesn't want to pay less tax? So when does it not make sense to apply this strategy? Well, you're realizing superficial loss and you plan to repurchase the same identical instruments and investment right away. Or the investment in a losing position are held within your registered account. Another example when it doesn't make sense is if the transaction fees are really high and the tax savings resulted from realizing the loss is actually less than the cost of executing the trade. And sometimes understanding that the transaction could also be selling a property as well to realize the loss to offset against the capital gain that you realized earlier on during the year. So the transaction cost can be sometimes really high. Another example that this strategy wouldn't apply to you is if you really are in love with the investment and you're bullish for the underlying investment and you really want to hold it for long term and you believe in the future and there is no other identical property, comparable property that you can invest in. So then you shouldn't realize that loss. And the tax loss harvesting would not work for you if there is no gain in current year, taxation year, or in the 3 preceding years, and you're not expecting any capital gain in the near future as well. So you don't need to harvest any loss if you are not expecting any gain or you have no gains. Well, tax loss harvesting reduces taxable capital gain. It will help you save taxes. All you need to do is to be mindful to not purchase, not repurchase, and the same identical investment within your own portfolio and your spouse portfolio, so then you would not be caught under the superficial loss. Until next time, happy Canadian real estate investing.